I don't need to tell you that it has been a crazy time in the bond market. And you think about BINC and how you've been structuring the portfolio. I mean, how has that changed as we've seen yields on, feels like everywhere across the curve, just really skyrocket over the past couple months?
Thanks, Katie. Thanks for having me on. So a couple of things. First of all, we've brought down our interest rate exposure. We were running about 3/4 of a year longer than we are today. We're running, as Eric said, just over 2 years of interest rate exposure. We're keeping our interest rate exposure in the front to the belly of the yield curve. And the reason why I think we're pretty close to flat for the year, the AG's down, I think, over 300 basis points. It's just keep income, and you don't need to go out the yield curve because all it's taking is volatility into the portfolio. So what we're trying to do is keep our income high, and we're running we use a metric called horizon rate of return, which looks at what yield should you capture. It's almost 7%, so it's about almost exactly the basis point what it is in high yield. But we've been running at about 2/3 the volatility because it's much higher rated. Implied rating is high BBB, almost single A, almost low single A. So the idea is diversify, keep a lot of income, don't take a lot of interest rate risk, and just move it around. I mean, at some point this year, I think we're going to increase our interest rate exposure depending on the inflation data we get. But for now, let's just clip coupon and just make it through what is a tough rate period.
Hey, Rick, you said move things around, so I'm just curious about how nimble you are and in terms of how active of a role here. Are you talking when you hear from Jay Powell last week with this idea of a rates reset, you're going in and you're changing asset allocation that day?
Yeah, it's definitely active. I mean, I think the beauty of this for an investor going into it is we're trying to manage our interest rate exposure, and if we think, which I think will be the case this year, we're going to get to a place where we anticipate the data improving, and I do think over the next month or so you're going to get better inflation data. We'll start extending our interest rate sensitivity, and then the big thing for us, versus a straight high yield portfolio, is move to where the opportunity is. Like, for example, today we're running probably more European high yield than we've run historically. It's because as a dollar investor, you get an extra 150, 160 basis points of what's called a cross-currency, additional yield for being a dollar investor. So it's just trying to tactically allocate, use securitize, use mortgages, keep your volatility down, keep the quality and liquidity of the portfolio up. And it's, fixed income is a pretty esoteric. There's so many different assets you can utilize, and just use as many as we can to try and keep our yield up, but manage the volatility for people.
Yeah, and Rick, just looking at the portfolio, I did notice more securitized debt. The high yield, it actually looks like has come down a little bit, but again, 37% is pretty significant. What are you picking within that bucket?
It's a great question. So first of all, more Europe than I've run historically because of the currency. And by the way, we're keeping our European high yield in the front, short of the 2 to 5 year part of the curve. You carry really well. We like the carry to volatility there. And then, in high yield, quite frankly, a lot of the high quality high yield's not interesting. The spreads, you can get yields that are close in investment grade. It's not worth it. So the sweet spot today, high yields in the single B category, and then triple C's. You're talking about a lot of volatility introduced to the portfolio. So what we're doing, cut the high quality U.S. high yield, cut the tail of the bottom off, and then try and use your investment teams to figure out in single B where's your sweet spot. So anyway, the idea of being tactical within the asset class, I think, is pretty key for us.
So that's the story on credit risk. I actually want to talk about duration risk a little bit more, because you made the point that at some point you'll move out depending on the inflation data. You expect that it'll become, a little bit better in upcoming prints. But how much of that decision on duration depends on when you think the first rate cut from the Fed will be? And has that changed in the past month or so?
That's a great question. I mean, yes, exactly that. I mean, listen, I think you're going to get to the place where, this core PCE gets down to 2.5. We're running a little hot today, closer to 2 3/4, 280. So, as you start to anticipate that, I still think the Fed would like to get a couple of cuts in this year. It's getting harder for them to do that, but I still think they can. Once you get visibility on a couple of good inflation reports, employment, wages staying contained, then you can start to extend your duration. I mean, the thing that's key today is why mess with it? Just keep your income high, keep your interest rate exposure down. But it's going to be a big tool. Can you throw off, with a portfolio throwing high sixes type of yield, can you start to get some interest rate exposure, maybe get you some higher total return from that? So, listen, I think we're going to get there. But, that being said, the service level inflation in this economy is too hot. And hopefully
Yeah.
it'll come down over the next couple of weeks.
Well,
next
what
couple
makes
months, I
you,
should
I mean,
say.
hopefully, I think a lot of people are saying hopefully, Rick, but what makes you confident that over the next month or two, as you said, we're going to start getting better inflation data? What are you seeing out there?
In just about a minute.
Yeah, so listen, I mean, there's some things that have created exogenous, auto insurance, health insurance. Shelter comes down with a lag. I think shelter will start to come down. So, you take some of these that have been running at extremely high levels. My sense is they'll start to come, healthcare inflation will start to come down. But you got to see it. To your point, you got to see it. I think you will, but in the interim, it's like just clip coupon and life is good.